Some small Chinese companies listed in the U.S. represent potentially big profits, so says my next guest, Joseph Meuse. He is the president of Belmont Partners. Welcome. It's good to have you with us.
Thank you.
Explain a little bit about Belmont Partners, because you specialize in really bringing some Chinese companies to the United States in the way of helping them raise capital, but they don't do it through an IPO, right? They do it through something called a reverse merger. What is that?
A reverse merger is an alternative to an IPO. So the idea is, instead of waiting a year or 18 months and spending millions of dollars and hoping that market conditions are good when the IPO goes off 2010, they go into an existing public structure, an existing public company. The company merges in, the money comes in, right? So the company still gets the capital infusion, right, at the same time, and they list. And instead of doing it in a year and a half, they do it in 3 months, 4 months' time.
So is this a situation where the company or the listing already exists and it might have one name, and then what happens is you find a Chinese company that wants to come to the U.S., they say, great, we're going to do this, it changes the name of the company, and presto, you've got a brand new company, but it's using all of the existing underpinning SEC regulations and the filings.
Our existing public company called ABC Corp, or whatever it's called, it files its K's, its Q's with the SEC, full disclosure, Sarbanes-Oxley, the whole nine. It's just a much more efficient process. Again, instead of 18 months, 3 or 4 months, the company merges in, that company changes its name to reflect the new business operation, and it moves forward. And again, the Chinese company gets the capital that they need to grow.
Is this why, when I look at a lot of these Chinese companies and I look at where they're registered, it all says State of Nevada?
Right.
Is that the explanation?
That's a lot of it. So there are over 750, 800 public companies, Chinese companies, that have done this in the last few years. A lot of people don't realize that. And a lot of the NASDAQ companies that are out there that are Chinese-based are former reverse merger transactions.
And what about the market caps? Are these typically small market cap companies?
Anywhere from 100 million to 500 million, somewhere in that range. There are some deals as large. I know that one that's coming out of China with $500 million in revenue, right? So sizable. And again, a lot of these end up becoming NASDAQ companies.
And does this mean then that they have to then go out and try to get Wall Street analyst attention?
Right.
Because when you go have an IPO, you've already got that kind of lined up, because most of the analysts are already associated with the firms.
That's right. That's the one thing that's missing in the transaction oftentimes, right? You have to, when you have an IPO, you have liquidity on day one for the investors, right? Some famous deals that open at 20 and go to 30, they have a following. With the APOs, they tend to lag. It tends to take them 6, 9, 12, even 24 months before a real following is put in place. And that's where the opportunity is, because you have some wonderful Chinese companies out there that are trading at 1.5, 2, 3 times current year earnings, because they don't have the following established yet.
All right. Now you said APO. What's the?
It's called alternative public offering.
Alternative public offering.
That's right.
Now talk about one of the alternative public offerings. I believe China Valve Technology, is that one of them?
China Valve went public in December of 2007, raised $30 million in 2008. Great company. They build. It's an infrastructure play in China. You say infrastructure in China, everybody loves that. They build valves that are the size of this room, right? Industrial valves, valves that go into nuclear power plants, water treatment facilities. I mean, it's high-tech components that they're putting together. The competition are manufacturers in France, in the U.S. They're the domestic player in the space. It's a great buy.
All right, but let me ask you, if let's say they raised $30 million coming to the U.S. doing this alternative public offering, right. $30 million doesn't sound like a lot of money. Why would they do this? I mean, why go through the trouble of listing in the United States but only walk away with $30 million?
It gives them access to capital. So in China, to list on the Shanghai market, which is where they all want to list, don't get me wrong, it takes 2 or 3 years to do that, right? In 2 or 3 years in China, think about their growth rate versus a U.S. growth rate, right, GDP. 2 or 3 years in China might as well be 10 years in the U.S. Imagine waiting 10 years to get money, right? I mean, the economy is so dynamic, they have to get money today. They have to get access to money today. So they get a first round, $30 million, and they say, you know what, I'm going to need more in 6 months or 12 months, but at least I'll be able to let my stock appreciate, hopefully, as my company grows, so the next round won't be so dilutive. And they'll go back out and raise 80 million or 50 million or whatever larger number makes sense for them at the time.
And typically where they want to raise that second tranche, they want to raise that also in the United States, or they would rather raise
Absolutely.
that really in China?
Listen, they would all rather list in China, but now that they have to list in the U.S., they would much rather get the capital here.
Okay, all right. We're going to talk about some more of these companies that are trying to raise capital in the United States. Also, we're going to talk more about this reverse merger strategy and how to take these Chinese companies public. What's in it for U.S. investors? We'll find out. This is Taking Stock on Bloomberg. pfox11 at bloomberg.net if you wish to reach out to us. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Joseph Meuse. He is the president of Belmont Partners. Joseph, let's continue talking about some of these Chinese companies that have gone the way of alternative public offerings. One of them is Lotus of Pharmaceuticals. Tell me about that.
Now, that's a really interesting deal. LTUS is their symbol. Pharmaceutical deal, not only on the retail side where they have pharmaceutical locations, right, but they also have new products coming online pending approval from the SFDA. Their earnings Q1 up 400%, historically growing revenues over the last few years of something like 60%. Healthcare is a growing business in that country. You've got a growing middle class. The government's trying to reach out to some of the rural areas to give them more benefits. Stock's trading at 1.5 times 09 earnings, because it doesn't have the following yet, right? The American investors haven't found it yet, but it's a great buy opportunity as far as I'm concerned.
Okay, but let me just press you a little bit, because when you talk about it doesn't have the following, I mean, what do you say to people who say, well, there's a reason it doesn't have the following, because these are small, these are unproven companies. They wanted to go through the whole vetting process. They wanted to wait 3 to 5 years in order to list on, in a regular IPO. Does that make sense?
Yeah, I guess it makes a little bit of sense. At the end of the day, they've got great audits. They've got a proven track record. Lotus has been public for a few years. They've got a great management team, and they're growing at over 50% a year. Try to find that in the U.S., and try to find that at a multiple of 2. Try to find that at a multiple of 10. Right, you're not going to find it. Here's a multiple of 2. And it's the inefficiency of the market that you spoke of earlier, which was a great point, that the analyst coverage hasn't kicked in yet, right? It hasn't started.
Well, there's no value really for them to do the coverage, right? I mean, because they're not going to get any investment banking business. There's no.
That's right.
There's no real.
That's right.
Trading of the stocks. I mean, these are thinly traded, right?
On Lotus, it trades, I believe, hundreds of thousands of shares every day. I mean, it has a following, just not enough of a following that's out there. Keep in mind, you've got 800 of these newly listed Chinese companies. It's a lot of supply, basic supply and demand. It's a lot of supply. A lot of U.S. investors, especially in this market, are going towards safety, right? They want to buy a GE or Microsoft. They don't look at Chinese stocks as risky. I think that's where the opportunity is.
All right, let me ask you another one. China XD Plastics. You also want to talk about that.
CXDC.
What are the plastics for rearview mirrors?
Right. So in China, CXDC focuses on plastics in the automotive industry. In China, there's 1 car for every 100 people. In the U.S., 76 cars for every 100 people, right? They're the one pure plastics play in the automotive industry in China, and they're publicly listed. While in the first quarter of this year, Ford, GM, they went through a lot of pain. We all know about that. CXDC, their revenues were up 150%.
Now, do they supply to just the domestic manufacturers, or also, let's say, the GM that makes
Audi, GM?
So even the foreign makers
absolutely.
in China.
It's a really neat company.
Okay, all right. Well, we're going to have to follow what goes on with these alternative public offerings. I want to thank you very much, Joseph Meuse, coming in from Belmont Capital to share your perspective and really turn us on to what's going on in these small cap names. Thanks very much.
Thank you, Pim.
Appreciate it.